We are half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Haidi Stroud-Watts in Sydney with Annabelle Droulers in Hong Kong.
Our top stories. Most Asian stocks gain with the dollar rally cooling, even as traders scale back their bets and expectations for a Fed rate cut next month. China are about to release key economic data, including retail sales, industrial output. Expectations are high that stimulus is starting to have an impact. But JD.com's moderate revenue growth signals a cautious recovery in Chinese consumer spending. Alibaba are also expected to report slower sales from its e-commerce platforms.
Let's take a quick look at the market action. It was a couple of hours into the start of trading across major markets and ahead of that open in China. Let's take a look at, we are seeing some broad upside, largely getting that lift from Japan, even as traders continue to scale back on expectations for the Fed's easing trajectory, including the rate cut next month is now into question. That really weighed on the overnight session in the US, but Japan stocks in particular really being supported by the weakness in the yen. But of course, quite a bit of uncertainty when it comes to expectations for where the China rally goes from here. That stimulus-fueled rally has sort of come unwound in the recent trading sessions. Take a look at what we're seeing when it comes to the Golden Dragon Index, and we are seeing some of that weakness, particularly when it comes to big tech. Interestingly, though, we have seen Michael Burry, of course, of 2008, betting against the US housing market fame, further upping his exposure to key China tech stocks, including Baba, JD.com, as well as Baidu, but also leveraging a little bit to the downside with a strategy of put options that would allow him to potentially sell, lock in profit or limit losses should we see a further sell-off. So we'll be watching that very closely. Also watching the yuan fix as well. Of course, the sort of speculation is that should we get the implementation of further Trump tariffs, that the currency could be one way that we see Beijing potentially respond. The PBOC has been pushing back against that yuan weakness, of course, by setting that stronger fix against estimates. But we're also watching the actual limit or level that we see, right, against market expectations, Belle.
Yeah, that's right, Heidi. And there's really that expectation building. Yes, we have sort of seen the PBOC signaling maybe it's not so comfortable with that yuan weakening trend. But at the same time, it's definitely one of the levers that it could pull on if that tariff war really does escalate. Here's what we're watching today in Greater China. You mentioned, of course, that focus on earnings. Alibaba is one of the ones that's due up next. Expecting slower sales growth. Definitely going to be really tracking what they say about the single-day sales in particular. Lenovo, another name we'll be watching at the open here in Hong Kong. We had their earnings out earlier and we saw profit beating estimates. Really tough quarter as well for PC sales. Economic data-wise, well, it was still in that window for the FDI data. It's actually closing pretty fast. We're going to get it out at least within today. And then in the next couple of hours, we've got the activity data readings, home prices. Those numbers are due as well. But we're going to get into the details now of that activity data in particular. Bring in our China correspondent, Min Lo, joining us in the studio this morning. And certainly those October figures, we're going to be wanting to see, did that stimulus announced in September start to feed through?
Yeah, this is really the first full month of data we're getting since the September stimulus, as you said, and forecasts are showing that we're seeing improvement across the board pretty much, except for unemployment, which is expected to stay steady at 5.1%. But if you look at industrial output, that's forecast to grow at 5.6%, the most since May. Retail sales set to climb by 3.8%. That's the fastest pace this year. Fixed asset investment as well expected to improve slightly, and a modest recovery in property investment. But there are a couple of things that really stood out to me is retail sales that's expected to hit a record in October, and that's partly boosted by that October Golden Week holiday where there were more than 750 million trips made domestically. But of course, we're still far below the pre-pandemic average where we tend to see 7, 8, 9% growth in retail sales. We're far from that, but it's still a key milestone given this broad weakness in consumption sentiment. Bear in mind as well, the government has yet to pull out a very large-scale direct stimulus targeted at consumption. So does that mean that retail sales still have some legs to go? As well, the industrial output data, we got some early indication from the PMI, both the official and the Tyson beating expectations. So investors will really be looking out for whether the other economic data that follows continue to support that recovery story.
We also have home sales data due out just a few minutes' time. What is that looking like, given that it's so core to the broader recovery, particularly for household sentiment?
Yeah, again, this is the first test since we saw that series of measures that were rolled out over the past couple of months to support the sector. And we did already get preliminary data from the China Real Estate Information Corps showing that home sales in October picked up and really reversed from negative territory to positive territory for the first time in about 16, 17 months. So key to watch is whether the official data also support that story. And what's more important is whether that pickup in home sales is helping to halt that decline in home prices, because we have seen the home prices at its worst slump so far. It's been declining every single month since early 2022, and it's been steepening decline since middle of last year. So it will be key to watch how quickly the government can really make good on their pledge to stop the decline in the housing sector.
Bloomberg's China correspondent Min Min Lo there. We do have some breaking news when it comes to key automakers across the Bloomberg. Now, Hyundai Motor naming Jose Munoz as a CEO. He becomes the first non-Korean CEO to take the helm at one of the Asia's biggest conglomerates. He's age 59. He formerly worked at Nissan Motors and joined Hyundai in 2019. So he's really the first foreigner to lead the automaker as it seeks to try and stoke growth outside of its home market. He's currently in the role of the global chief operating officer, and that announcement has been made after earlier speculation. It comes as we see this leadership reshuffle at Hyundai. It's facing uncertainty of US policy for EVs, rising competition with a number of Chinese car makers as well in the European market as well. We did see American auto stocks and some of the Asian names as well falling, given that report that President-elect Trump would eliminate a key tax credit for EVs. Well, Fed Chair Jerome Powell has thrown a December rate cut into doubt, saying the strong performance of the US economy means there's no rush to ease.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Let's bring in for some analysis Salman Niaz, who's ahead of global fixed income for APAC ex-Japan at Goldman Sachs Asset Management. Salman, great to have you with us. Do you think we're at a pause now for the Fed?
Morning. Thank you for having me. It's a pleasure to be here. Look, I think the outcome of a historic election that we just went through puts growth squarely back on the picture in the United States, with potentially more efficient government, tax backdrops, fiscal spending, and generally a America First policy. While the implementation and the timing of this policy is not clear, it's very clear the direction of travel is towards a stronger backdrop. With the recent data coming out both from the labor markets and the pricing markets, it's clear that the economy continues to be quite stable. While it's slowing down, it's continuing to grow. So the path for rates forward remains in flux in many ways. We do think that the rate cutting cycle is going to continue. And I think the markets are generally also voting in the same direction. If you look at what's priced into the markets today versus what was priced in 45 days ago, the markets have taken out over 3 cuts from the U.S. Rate picture for 2025. We think a December cut is in the cards. We think that there will be at least 2 cuts next year. But as I said, it's in flux.
Given that flux and pretty high degree of policy uncertainty, where are you seeing the opportunities?
So that's a great question. I think there's a few things in the backdrop that have changed quite meaningfully. Post the hiking cycle, two things have happened. One is the dispersion in the macro markets has increased quite significantly. And that's made it quite interesting for active managers to be able to monetize and harness some of that value cross markets. So rather than just only taking directional views, the ability to take cross-market views where macro directionality is in different dispersing directions is quite attractive. That's one. And then secondly, I would say from a broad picture standpoint, where we see the ability to capture more returns is in moving across fixed income sectors. It's clear that many of the spread markets are trading at historic levels in terms of spreads, maybe not in terms of yields, and the ability to move across fixed income sub-asset classes is quite attractive. And in that regard, based on current backdrop, where growth is picking up, the outlook for rates is in flux, as I said, we think there is an attractive case to be made for securitized markets. There's an attractive case to be made for active selection in markets that are slightly more dispersed, which could include some of the higher yielding, lower quality part of the bond market, the levered loan market, private credit markets, but also in emerging markets where we see quite a bit of dispersion, and ability to actively capture some returns over the next 12 to 18 months.
Salman, can you drill down a little bit more on where you're seeing those opportunities, particularly in emerging markets? Because we did have that outlook around sort of divergence for central banks. Is it going to end up being constrained, though, if we see that dollar strength persisting?
I think Annabelle, that's a great point. I think certainly because the U.S. dollar strength and the path of the U.S. Fed is in a bit of a flux, it does, in many ways, put some of the rate cuts that previously were in play in some of the emerging markets potentially under review. The strength of the dollar has obviously taken away quite a bit from the returns of emerging market local currency bonds, but we think that the more attractive opportunity at this point is in the hard currency aspect of emerging markets, whether it's emerging market sovereigns, it's emerging market corporates, where we see quite a bit of structural risk premium in the asset class, or even in parts of the Asian fixed income market, where we see quite a bit of risk premium in the Asian high yield market, which is now post the default cycle in China property, is not necessarily a China story. It's much more of a regional story focused on South Asia and Southeast Asia.
This is a little bit of a left field question, but I'm wondering how much of attention you're paying to the risk that China offloads all or large parts of its stockpile of US Treasuries if that trade war with the US escalates next year. We saw really that huge Yang carry trade unwind this year, the havoc that it wreaked. Are you putting any sort of attention on China as well?
Yeah, look, I think it is a topic that's been part of the debate for a long time. Every time there is a bit of tension in the geopolitical space between China and the U.S., this question comes back up. I don't think the answer changes today versus what it was before, but I do think there's a number of things to watch out for as it pertains to China. Chinese economy had been slowing down quite rapidly, and the government has started to take policy actions and, more importantly, started to guide forward for more policy action. We think that the government does have the room to act, although they will, we think, be much more focused on stabilizing growth rather than, entering into a phase of accelerating growth back to historic levels. In that regard, I think there's a lot of opportunities in China. I don't think necessarily that there is a need for liquidation of reserves. I think they do have other pockets and capacity to support their policymaking objectives.
Salman Niaz, who's ahead of global fixed income for APAC ex-Japan at Goldman Sachs Asset Management. Really great to have you with us. Still ahead, JD.com's latest results raising new concerns about Chinese consumer sentiment despite a 5% revenue jump. Analysis from Arete research later this hour. But first, APEC leaders gathering in Peru.
Bracing, Haidi, for the impact of fresh trade wars as Donald Trump, of course, vowing to put America first. And we've seen that impact of geopolitical tensions on Chinese equities. Again, as we look ahead to the open of trade in Shanghai, Shenzhen and Hong Kong, futures are telling us perhaps we have another day of weakness ahead. This is The China Show. You're watching the China show. Just had the yuan fix coming out in the last couple of minutes. The reference rate, another stronger than estimated reading coming through the set at 7.1992 today versus estimates for 7.2471. But it's certainly that continued story that we have around the PBOC, maybe not as comfortable as we thought about that yuan slide, even though we have really seen it also dealing with dollar strength on the flip side. But let's shift now to the US, where the president-elect Donald Trump wants Robert F. Kennedy Jr. to run the Department of Health and Human Services. Bloomberg Asia senior editor Bill Ferries is with us. And Bill, I mean, we've seen kind of a number of controversial picks across the week. Matt Gaetz stands out, for instance, but this is another one that's likely to attract certainly a level of scrutiny in the Senate.
Absolutely. Robert F. Kennedy, someone who's really questioned the effectiveness of vaccines. He's talked about having fluoride removed from drinking water and other things like that, very unconventional views. He will also likely, if he gets to the confirmation process, face a lot of scrutiny, even from Republicans, about his views on health care. President-elect Trump, during the campaign, at the very end, said that he would let Robert Kennedy, quote, go wild on the health care system in his effort to make America healthy again. That was the slogan they used. But we're already hearing from Republican senators, including the new incoming Senate Majority Leader, John Thune, that there's going to be a real scrubbing of these candidates and a look into their backgrounds and their history, but with a particular focus, it seems right now, on RFK Jr. and Matt Gaetz, the nominee for Attorney General.
Yeah, and on Matt Gaetz, we're hearing that senior Senate Republicans do still want the details of the ethics probe into sexual misconduct, right? There has been quite a bit of conversation as to whether this is, I guess, a serious appointment, whether it is just an opening bid. There would obviously be sort of backup names for President-elect Trump if Gaetz doesn't get through.
Yeah, so there was this House Ethics Committee report that was due to get released, I believe, today originally. Gaetz, his resignation from Congress kind of put that on ice. I would be very surprised if that report either doesn't leak out in some form, or if the Senate isn't able to get a copy of it for their consideration in a confirmation hearing. I think he is probably seen as the highest risk of the nominees so far at this point. We've got to remember, in 2016, Donald Trump had 2 or 3 of his nominees who didn't quite get to the confirmation process. That's fairly normal. But it is very unusual for confirmation hearings to take place and then have the candidate get rejected. It's really been a couple decades since you've had a high-profile nominee get rejected by the Senate. But these hearings, if all of these people, Matt Gaetz, Pete Hegseth for Pentagon, RFK Jr., if they all go to confirmation hearings, this is going to be very interesting TV. It will definitely be a spectacle as Democrats and some Republicans push back on these nominees.
Bill Ferries there with the details, and obviously there's been a flurry of names and appointments, and we've been looking at those, but Donald Trump says Jamie Dimon is not one of them. He says there's no room for Jamie Dimon in his new administration, after previously saying that he may consider the JP Morgan CEO for Treasury Secretary. Dimon responded while speaking to us at the APEC CEO Summit in Peru.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
Dimon also told us, though, that he is expecting a deals boom under the second Trump presidency, with the new administration seen as being more amenable to mergers.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later I said 1 in, 5 out. I think they can do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit, and so and you could have kept the banks equally safe, but had them do more credit. And so, like, to just give you an example, the average bank in America, I think the number is, used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulation that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. Yeah, it's a huge disadvantage. So yeah, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JP Morgan.
There's also a question, whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together?
Yeah, so yeah, absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen, and one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal, it's binding, you haven't closed it, but now you've got to run the company. You can't get the synergies, you're going to be losing people. You want to start working in a common culture and common technology, you can't do it. So yeah, a lot of companies are looking at, will be looking much more aggressively at acquisitions and deployment of capital, and they should.
Quick check on some of the stocks ahead of the open here. JD.com, of course, in focus. We saw those ADRs slipping. That's coming across in the Hong Kong session so far. Fourth quarter investments really raising concerns. NetEase, though, you can see surging after its third quarter numbers. Let's change on. Quick check on the copper miners or copper buyers as well in China today, given we've seen importers reducing their annual copper purchases and instead shifting to spot supplies. We'll have more with the open next. This is Bloomberg.
And of course, we are seeing the President-elect Donald Trump there set to speak at Mar-a-Lago at the America First Policy Institute. We'll be watching to see the sort of narrative that he strikes, as of course him and his team have already been very busy giving out these posts under his second-term administration, the latest of which we've seen the former Congressman for Veteran Affairs being tapped, a no to Jamie Dimon, but of course we've seen Robert F. Kennedy Jr., who has been quite prominent in terms of his approaches to vaccine skepticism, his desire to do things like remove fluoride from the water, and his sort of really attitude towards big pharma as well, really making him the head of this Make America Healthy Again movement. He's been tapped to lead the Department of Health and Human Services. Belle.
Yes, certainly AFPI becoming quite an influential force in the MAGA world. So we'll have more on that. But let's also take a look at what's happening with the China markets this morning, because the CSI 300 has just come online to the downside this morning. Really a lot ahead, because we're just in the window now for new home prices. Those should be out in a couple of minutes. We've got activity data also coming out in the next hour. And that's going to really tell us that stimulus measures that came through at the end of September, how is that going to affect the October numbers? and will we start to finally see a bit of a pickup? Certainly what's come through in the earnings picture so far is overall a note of caution. We've got some of those names today to focus on. JD.com, for instance, ADR's slumped overnight. NetEase, though, doing better than expected. But again, let's just focus back on President-elect Donald Trump. That's really the shadow that's been over markets, given you've got that risk of protectionism coming through, that America First policy, and what does that mean for the mainland in particular. Let's change on. Quick check on Hong Kong, given we've seen the HSI down for 5 straight sessions. Today it does look to be bucking that. But Haidi, let's also take a look at what's happening with the property numbers as well.
Yeah, we do see a decline. New home prices for October falling by just about 0.5% month on month. This slump, it is sort of moderating from the previous decline of 0.7%. We're seeing used home prices in October also falling by just about 0.5% there as well. But of course, this continued spiral low when it comes to the housing market is really one of the key factors as to how and why we've seen China, the broader economy, being pushed into deflation. We have kind of seen a recent rebound of sorts, softly speaking there when it comes to property sales. That's mostly taken place through those larger cities. We have seen new support measures, that sort of broader lifting of sentiment, as fragile as we can sort of characterize that. Even just this week, right, we've seen policymakers in Beijing cutting that property transaction tax, yet another kind of meaningful but perhaps not dramatic fiscal push. We're going to need to perhaps see a lot more, Bill.
Yeah, and Haidi, as we said, President Trump, their elect, speaking at an America First Policy Institute event, what's becoming a really influential force in the MAGA world. But let's listen in.
He's doing that. He's actually doing that. Just happens to work with EA. That one we don't have to worry about. It doesn't work so well with other countries. But you know what? I think your numbers are working also. You've done a fantastic job in a very short period of time. It's an honor to have you here. That's really great. Thank you. Also, Speaker Mike Johnson, wherever you may be, Mike, in this very big and crowded room. Thank you, Mike. I went yesterday, just in case, I said, look, I want to tell you I'm behind this man 100%, and he got 100% of the vote from Republicans. Are you sure? You sure, huh? No, he's doing a great job. Nothing easy. We actually had one little period, about 4 weeks, where we had a majority of 1. That was not pretty, right? And you handled it beautifully. He just kept that stiff upper lip, but he's doing a really good job. And that was a great vote you got yesterday. Totally unanimous vote. Congratulations, Mike. That's beautiful. Members of Congress, all of whom voted for Mike, and they've been my friends. It's just a small group, but we have a lot of them outside, and we have a lot of them coming over the weekend. Byron Donalds, the star. Where's Byron? Byron, what a star. What a star. Thank you, Byron. Ronnie Jackson, Doc Ronnie, he's been a lot of things. He was my doctor. He was a great admiral, you know, highly respected admiral, great doctor at the White House, and now he's a very popular congressman. He won by 48 points. That's pretty good. Of course, it was a very, very Trumpy district, but he won by 48 points. But when he was a doctor, they asked him the question, the fake news, which is here. Look, wow, that's a lot. That's a lot. We invited him, and they said, can we come in? I said, we have nothing to hide as Republicans, right? We have nothing to hide.
We'll leave that there, but that's the US President-elect talking at America First Policy Institute event, talking through really the results of the election there, but you can catch up there if you turn to our T-Live function. But let's also check in, because we're just a few minutes into their session now for mainland equities, also Hong Kong trading. And this is the state of play for the tech stocks so far, and we're seeing broad downside pressure here. JD.com standing out. We did see ADRs slipping overnight, so this is sort of expected, the reaction. Analysts were actually pretty positive on the top line level, but they're a little bit concerned around the outlook and spending in the fourth quarter in particular. Alibaba also due to report its numbers. Tencent, that sort of, again, concerns around the broader outlook. And Meituan, that's coming up next week. But let's get more on this now and bring in Shawn Young. He's senior research analyst at Arete Research. Shawn, what's your take on what we've had from the numbers so far? Because there was a lot of expectation on these names to deliver. Do you think we've seen that so far?
Right. I think that's one of the interesting things is about the market expectation versus the real, the numbers. For example, if you look at last night, JD and NetEase, JD's number, as you said, that seems are okay or good. But the problem is that I guess the markets have higher expectation for example, the central government's subsidy campaign to boost the electronic devices sales. The other thing for NetEase is that if you look at NetEase number, actually the revenue, the top line and bottom line seems that year-on-year decline. But on the other hand, that investors have more pessimistic view ahead of the earning. So that's why you see that I think there's interesting things about to observe the actual number versus the market expectation for China in tech companies.
How do you sort of reason with that then? Because if you're saying sort of the market expectation is too high and they're not really paying enough attention to what has been some signs of strength in the figures, what do you think is going to sort of shift then the thinking around the numbers?
Right, I think that the markets probably that a lot of investors, it's easier for them to track some numbers. For example, like the Double 11 GMV sales. I have seen a lot of like third-party data monitoring company publish numbers. Seems that this year's Double 11, the overall sales are okay. But on the other hand, that if you look at Tencent number, they said that e-commerce companies have increased advertising spending on Tencent platform, and JD is also like seems that sales marketing increased a little bit. So I think that investors probably it's easy for them to capture some numbers, as I said, the GMV or sales. But on the other hand, when the earning comes out, then people find okay, probably it's because that these companies like invest more in sales and marketing, then that probably gives like some colors that people didn't expect in the past.
You're more constructive when it comes to JD versus Alibaba. Can you tell us why?
Right. I think that the JD's logic is that starting from the September and October, then the China central government starts to launch something called electronic subsidy campaign. That basically that's the central government has given like direct subsidy, and JD is the largest online platform selling electronic devices. So we think that the logic is very simple, that JD is going to benefit from this round of the subsidies campaign. But on the other hand, for Alibaba, we think that a lot of like positive factors, for example, the increased take rates, the GMV recovery, and also integration with WeChat seems that have already been priced in the stock price. So that's why we have we'll have a neutral rating on Alibaba. So yeah, I think that it's more about the I think it's about fact versus expectation.
How do you, I guess, place the outlook for these companies, both in terms of obviously the domestic macro pressures that we're seeing, but also the geopolitical and more global tech uncertainties that we could see with the second Trump administration?
Right, I think there's some. First of all, I'm always say that I'm not a macroeconomist, but if we look at China internet, unfortunately, it's also very related to a lot of macro factors now. I think one is about China's overall like macro condition, especially some policies to support the consumption, because there are Baba, JD, PDD, Meituan, they're all like quite closely related to these policies. So far, we have seen JD's benefit from that, and we would like to see more policies coming out. The other thing probably is more about the U.S. and China relation, because PDD has like Temu businesses, which I think that's part of that's the revenue coming from the U.S. So you see that PDD's stock price is under pressure recently. I think that's also because people's worry about the coming the next year's China and U.S. relationship. For other sectors like gaming, I think that it's relatively more independent from the macro, but it's also having some challenges. For example, it's getting increasingly difficult to have some innovative games right now to develop a hit blockbuster game. For advertising, I think that we have seen something like AI have been playing increasingly important role in the West in terms of ad tech. But we haven't really seen that in China, and we hope that to see AI can play a more important role going forward.
Yeah, well, what's your outlook for gaming in particular? Because our Bloomberg intelligence analyst, Robert Lee, he always likes to say you're only as good as your next hit. And he'd be a little bit more bearish on the outlook for some of the gaming names, particularly moving after the first quarter of next year. So what are you seeing for Tencent, NetEase as well?
I would say probably that's Robert. I agree with Robert that the overall China gaming industry seems to reach to a point that it's actually very difficult to have another new real blockbuster game going forward. I guess it's also seen in the global same thing versus global market. It's just getting increasingly difficult to make some breakthrough in new game genre. But on the other hand, you see that, for example, Tencent and NetEase, some of their old legacy games have benefited from that. I think the logic is very simple in that when gamers it's difficult for them to find a new game, they probably will return to the old game. And all these gaming companies, they are basically adding a lot of content to create something more like platform. So in that way, I think that Tencent, because of the large DAU, because that they are, they have a little bit better pipeline than NetEase. So I think that Tencent probably is in a slightly better position. But overall, I think I would agree with Robert that seems that China gaming industry is entering a new period of time that it's, there's more challenge, and probably that they need to look for new devices and new technology, or probably AI, or other console games, other software, or globalization, global expansion.
I'm glad you bring up AI because there's growing consumer interest, right, particularly when it comes to chatbots. Where do you see the most tangible progress and sort of optimism being made there, given that we're also seeing a number of the big names like Baidu, for example, losing ground to some of these startups?
Right. I think China's AI is very different versus what is happening in the US or in the West. I think one of the things is that if you look at all these China AI companies like Baidu, Kimi, and probably Beidou's Doubao, they're actually doing a lot of sales and marketing campaign to acquire users. So in China, I think a lot of language model apps, they're more to C rather than to B. I guess that's partly because, in China, that it's always difficult to do some to get money from these enterprises. And the other thing we noticed is that it seems that those Chinese cars, EV companies, they are increasingly they are playing a more important role in adopting some AI in autonomous driving. So one of the things we noticed is that this year, that's for Ali Cloud, Tencent Cloud, their part of their incremental revenue actually come from these EV companies. So I think this is something these are probably two big differences if you look at China's AI industry versus the US or West.
Shawn Young there, Senior Research Analyst at Arete Research, and Haidi, we've also continued to really track, what's happening in mainland China, but how are investors in the US thinking about China as well? And there's been those really notable hedge fund names and investors in the business, the likes of Michael Burry, for instance, loading up on their stakes, particularly following the stimulus measures that were announced in late September. What's interesting, though, is what's happened with Michael Burry's hedge fund, Qiao Asset Management, is that they increased their holdings in Alibaba, JD.com, Baidu as well, but at the same time, they've also increased their downside protection. So you're sort of preparing for any sort of eventuality here.
Yeah, same for Baidu and JD.com, right? So kind of the ability to lock in profits or at least limit the downside. It's quite interesting. We've seen from the billionaire investor David Tepper, of course, of Appaloosa Management, saying recently he would buy everything China-related amid the stimulus blitz. There is apparently one exception to that. It's trimming exposure to Alibaba in the third quarter. So quite interesting that we've seen that reduction of the stake by 5% in Q3, despite Baba remaining the hedge fund's biggest holding. So clearly there's a bit of uncertainty in terms of the way forward and perhaps how bumpy the ride is going to be as we await for more meaningful fiscal measures from Beijing. Plenty more ahead. This is Bloomberg. Take a look at how we're tracking very early in the part of the trading session for Greater China. We're seeing a bit of downside, though. The CSI 300 off by about 0.7%. Quite a lot of consumer-led sectors are seeing that lower trading today, despite expectations that in the data dump that we'll get a little bit later, we will see an improvement, particularly when it comes to perhaps retail sales. But at the moment, we're seeing discretionary names, real estate as well. We did get new home prices falling at a slower pace after the stimulus measures were announced, abating for a second month, but still falling by about 0.5%, both in terms of new home prices as well as used home prices across 70 cities as well. Used homes actually fell, but the least in more than a year. So while we continue to see these kind of incremental gains, if you will, from the stimulus package, clearly, Belle, we're waiting for a lot more.
Yeah, that's right. But what's interesting today is that there has been some sort of indicators that there could be a bullish sentiment of sorts in Chinese equities. We've seen trading turnover picking up, daily turnover, for instance, exceeding 2 trillion yuan for the past 7 days. Leverage trades, retail flows, there is some healthy momentum signals, but one of those perhaps is a unique public stock forum that's having a revival of sorts in China's financial capital. The daily outdoor gathering of retail investors disappeared during COVID, but as Stephen Engel reports, crowds are swelling rapidly again, spurred on by that government stimulus.
On this otherwise quiet, leafy Shanghai street corner, many opinions. From the stock market to even the next man in the White House can get quite vocal.
The market right now is so good. Look at how popular it is here.
He's talking about the so-called stock salon, an informal outside gathering of hundreds of mom and pop stock enthusiasts, everyone from so-called market gurus dishing advice to punters playing off the latest rumors, including the highly anticipated fiscal stimulus from the Chinese government. No wonder some call the Chinese stock markets a bit of a casino.
The stock market is a place with the most rumors. If you buy stocks based on rumors and sell based on rumors, you'll never make money. Believe in yourself and own your destiny. Don't trust others.
China's stock markets are, after all, dominated by an army of some 200 million retail investors. The street corner salon emerged more than 30 years ago when China set up its securities exchanges. But it went quiet after a market meltdown in 2015, moved online, and then went dead during the COVID lockdowns of 2022. But now, with a recovery in stocks since China unleashed stimulus in late September, the live salon has come roaring back to life, along with perhaps a lot of hopeful exuberance.
I think the bull market will last for 5 years or even longer because we have more than 300 trillion in deposits. The government won't let you keep the money in banks. It will be a burden on the banks, and it will be a drag of economic growth as people no longer consume. Now, everyone is relatively conservative since the pandemic.
Conservative with spending, perhaps, but many here did not hold back when it came to Trump and tariffs.
Let me tell you about the tariff. I can assure you that it won't be high. He's just saying that. He's a businessman. He will change his approach for profits.
These are short-term fluctuations. He may increase tariffs, but increasing tariffs will actually hurt the U.S. more. The U.S. still relatively relies on China.
Large unofficial crowds like this one in Shanghai can make authorities a bit nervous in China, hence the fairly large police presence. I've seen a number of officers kind of surf through the crowd looking for who knows what among the mostly male stock-picking punters. I even had a car pull up, the windows rolled down, 2 guys dressed head to toe in black, big smiles saying, "You want to make money, money, money?" Of course, I passed them up on their offer, but still, another couple got out of a Rolls Royce and went into the crowd. I guess everybody in this city of business is looking for a good stock tip or two. Stephen Engel, Bloomberg News, on a street corner in Shanghai.
Well, President-elect Donald Trump has finished speaking at Mar-a-Lago, where he was speaking to a crowd before the America First Policy Institute event there. He has just made another announcement saying that he will be announcing Doug Burgum, who's the governor of North Dakota, as the head of his Interior Department there. And there had been previous speculation that he'd been looking at Doug Burgum as a new so-called energy czar to replace the climate czar under President Joe Biden. But of course, the Interior Interior Ministry kind of makes up that sort of deregulatory agenda that President-elect Trump has promised across agencies, including energy, the Federal Energy Regulatory Commission, the Environmental Protection Agency as well. He's making comments about inflation before as well. We have to deflate inflation. We're going to slash energy costs there. Plenty more ahead. This is Bloomberg. In the next hour, we do have, of course, breaking news with this data dump expected on the domestic activity indicators across the Chinese economy. And this will actually be sort of the first early read of how that stimulus blitz has played out. We are expecting to see those early gains, the revival when it comes to industrial production, probably some early gains when it comes to fixed asset investment, as well as an improvement in the reading for retail sales. The issue is, of course, whether this is going to be a short-term boost, because it's going to be quite a feat to translate early gains into meaningful long-term and sustainable progress when it comes to getting out of this deflationary mindset, in particular for households. And we know that a big part of that is going to be an improvement in the housing sector. We have seen a more limited declines there when it comes to these latest housing numbers. We're getting analysis, of course, with Helen Qiao, BofA Global Research. She'll be joining us with her views next. Welcome back. You're watching The China Show. We're set to get China's October activity data soon, crossing the Bloomberg. And this is really kind of the first indications that we could see that the stimulus blitz that we had from Beijing policymakers will start to show up in the numbers. We are expecting a little bit of upside when it comes to really across the board, be it fixed asset investment, industrial output is expected to show improvement. And in particular, that sustained modest boost to retail sales could come through as well. And that's going to be sort of flattered by the holiday spending effect. We had a pretty decent Singles Day as well. That's going to be reflected in kind of the upcoming numbers over the next few months or so. But the biggest question really is whether these early gains, you know, these green shoots, if you will, can be transformed into something a little bit more sustainable and more structural, given that markets broadly are still hoping for more meaningful stimulus on the fiscal side. But of course, it's a combination of fiscal, of monetarily, as well as that question mark over Trump tariffs.
Yeah, well, Heidi, we've got those numbers just dropping now, and it's actually an interesting reading that's come through. We'll kick off with the retail sales here, because that is a certain beat or outpacing of what economists had been expecting. So coming in at 4.8% growth, the estimate had been for 3.8% growth. Remember, during the October period, we had the Golden Week holiday. We saw more than 750 million domestic trips. We haven't seen direct consumer subsidies from Beijing, but there's certainly been those efforts and incentives like shopping rebates, discounts for trading in older electronics, for new models. So that could be playing into these numbers. What else we're watching is the industrial output, and here it's actually disappointment. Yes, we saw a gain of 5.3%, but the economist estimate had been for growth of 5.6%, and it is a deterioration from the month prior as well. It's again, to sort of put it in the context of what we saw in October, actually during this period we saw the official and also the Caixin or the private PMI readings rising above the 50 line. We also saw stockpiles of steel falling in late October, production volumes rising. So that is certainly a figure to be digging into. Fixed asset or fixed investments coming in pretty much in line with estimates, growth of 3.4%. The estimate had been for 3.5%. Property investment, we're still seeing a slump in that. And the surveyed jobless rate, just a slight deterioration to 5%. The estimate had been for 5.1% instead. Joining us now, though, to get more on this is Helen Qiao. She's Chief Greater China Economist at Bank of America Global Research. And Helen, what stands out to you so far? There was as I said, the retail sales coming in a lot better than expected, but a deterioration in the industrial output figures.
Thank you for the question, Annabelle. I would say that the overall set of activity growth indicators seems to be suggesting that some of these easing measures are starting to kick in, and the Chinese economy is starting to show some signs of stabilization. In fact, I would say the most notable one is the retail sales number, indicating that consumption probably gained some momentum, helped by the consumer voucher mechanism, and also the earlier than usual kind of starting time for the Singles Day sales in October. So those are probably all helpful, and it is really reassuring to see that consumers are now starting to loosen the strings of their purses a little bit. The second thing I think that stands out is actually the IP. IP at above 5%, I think it's definitely a positive sign. We were expecting somewhere around 5, but clearly that after seeing export growth surprising on the upside, I think somewhere around 5.3, 5.4 would be reasonable. It was slightly lower than last month's 5.4 reading, but I would say that given what the numbers, the high frequency numbers that we have seen so far, I think this is a pretty positive reading as well, indicating that industrial activities in China have also held up better than in previous months relative to expectation.
Picking up what you're saying there about the retail sales, and maybe we're seeing that, consumers might be more willing to dip into their wallets. But how sustainable do you think that is? Because to your point, this was a period where we had the Singles Day sales starting earlier than usual, and also we had the Golden Week holiday.
Yes, the Golden Week holidays also it's potentially helpful, but at the moment, I would say that probably we see some early signs of stabilization that indicate that we could probably see a bit better, consumption momentum compared to the weakest point that we saw from June to September. I think what is quite helpful is that whether the policy easing measures that I just mentioned, for example, on cars and also on electronic appliances purchases, people can easily get subsidized and using the vouchers even when they're using the online shopping apps, and those are extremely helpful. And I think the biggest question now is whether the local governments would be able to keep up using these kind of stimulus measures going into 2025, and presumably the goal of stabilizing and boosting consumption is still going to remain unchanged, and that would imply that local governments would probably have to keep up with this kind of subsidies for a little bit longer. Otherwise, we may actually see an early petering out.
Helen, we are hearing some commentary from the National Bureau of Statistics as well, saying that the domestic demand picture remains insufficient, that China vows to achieve the 2024 annual growth target, that the Economic Recovery Foundation needs to be consolidated. I do wonder, obviously, expectations or hopes are for more forceful stimulus measures on the fiscal side. Does that achieve the goal of being able to drag the economy out of deflation if what we're dealing with is a fairly structural side slowdown?
Well, very good question, Heidi. But I would say that at the moment, it might be a little bit too early to tell that whether these easing measures will be sufficient in reflating the Chinese economy. What we're currently seeing is a combined force of both structural as well as cyclical forces, and such headwinds are not necessarily abating. So at the moment, it is very encouraging to see that some of these short-term counter-cyclical measures are starting to kick in, and therefore we are seeing some better numbers from consumption side, and also pretty much stabilization on the investment side. Industrial activities are holding up better, but at the moment this is not necessarily addressing some of the long-term issues that we believe that we still need to see better structural adjustment of. For example, we think that there is a general lack of positive incentives at the micro level for public sector as well as private sector people working in them, and we think think that is probably something that that policymakers would have to address, so as to make the policy adjustment and also the stabilization more sustainable. Going forward, I think that is also extremely important to watch that in 2025, when we see more headwinds from the export sector because of the trade tension intensifying, then what it means to policymakers in China is that they probably have to do a bit more.
We're going to get a little bit more on trade and the kind of geopolitical aspect of the risk in a moment, but I wanted to actually have a look at the home prices. It was still a decline, another decline, but less so. So I suppose that's the optimistic side. But on that, do you think these demand side measures are going to be enough, or do they need to be focusing on supply side measures and running down inventory to make a meaningful impact, which of course then could flow on to boosting broader economic sentiment?
Very good questions. I'm afraid that the property prices decline, especially the prices that NBS is talking about, is usually referring to the so-called new property prices. And such new property prices are probably not going to stabilize or show signs of improvement until the point when the secondary market shows stabilization, and most of the people who are waiting to sell in the secondary market have already managed to sell what they're holding. At the moment, we are seeing better volume in the secondary market, starting from about late September, early October, but that has not translated into better sales in new property market, and therefore I would say that this is probably going to take a bit longer than some people may say. In the next 2 to 3 months, that we will see a stabilization in new property market in sales or pricing. I think this is probably in the next 6 to 12 months at least. Secondly, I would also mention that as you said, the demand side policy adjustment, especially kind of dialing back the restrictions on the housing purchases, are probably going to be adjusted further down for any remaining ones in our view. But more importantly, we also need to see on the supply side, probably the government's local government's initiatives to try to purchase some of the land and also unsold homes to turn them into social housing, I think could also potentially help. At the moment, we are seeing some of these measures, stepping up, as the PBOC mentioned that their funding support for local governments to do so has stepped up. But and unfortunately, we're not necessarily seeing some, green shoots yet in terms of such measures already materializing in large quantities. And therefore, I think that, going back to what we just said, it may probably still take time for us to see this goal of putting a backstop to the declines in property market and stabilizing the stock market, property market going forward would be achieved.
Helen, do stay with us. Helen Qiao, who's the Chief Greater China Economist at BofA Global Research, is staying on with us. We're going to talk about some of those external challenges for China next. And you can get more analysis on your Bloomberg as well. Go to TLAVGO to get commentary and analysis from our team of expert editors. This is Bloomberg.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Well, US President-elect Donald Trump has threatened to go up to 60% of tariffs slapped on Chinese goods. And Belle, of course, this has been a cornerstone of now both of his last two election campaigns, right? And we have no reason to believe that perhaps he wouldn't be as hawkish on China as he's promised. We've been looking at, the idea of that maybe Beijing is a little bit more prepared this time around, that perhaps the sort of trade environment is different, the tools at China's disposal at this point. You talked a little bit about treasuries, and of course they could, use the currency play as well.
Yeah, that's right. And we kind of have seen that broader theme developing, perhaps even though we've had a pushback in the yuan fixing each day this week. But still, they could look to weaken that. Does that, though, sort of stoke the ire of some of the other countries in this part of the world? India, for instance, has signalled they'd also be prepared to let their own currency weaken. But there's other measures they could take as well, restricting critical minerals, for instance. We saw gallium, germanium, for instance, being restricted from export last year by China, targeting US companies, alliance building. And that's, we've got the APEC, the G20 summits coming up. We know President Xi is there, and the US presence, we've also been told, hasn't been that strong.
Let's get some analysis now. Helen Qiao is still with us. She's the Chief of Greater China Economist at BofA Global Research. Helen, we really appreciate your time. And look, this idea of these asymmetrical weapons, right, blowing up their US Treasury holdings, weakening the yuan to be more competitive, all of these strategies come with significant blowback and disadvantages to Beijing. Are these real options, do you think?
Well, good questions. I think they are still options, undesirable ones, but they are still options. But would China necessarily choose to use them, especially use them aggressively? I doubt it. Mainly because that I think these are the ones that people easily can come up with, but they all have the downside of basically hurting the U.S., but at the same time also hurting the Chinese economy itself. And compared to 7-8 years ago, I think the Chinese economy is not necessarily in a stronger position, and therefore I think having these kind of measures that serve very much like a double-edged sword is not necessarily going to be the best option. In our view, there is still a lot of room for negotiations, and we think that the Trump administration would potentially be open to negotiate with China like it was last time. Of course, people are saying, oh, last time China reached the first phase one deal with the U.S. in early 2020, but it failed to achieve that. It didn't buy up as much as those agricultural, energy, and also manufactured goods as it promised to. But I think that was back in 2020 when we were hit by by COVID, and the transportation globally has been significantly disrupted, and trade was very much hard hit. And therefore, I think there was a reason why the deal wasn't necessarily delivered. But this time around, I think that we still remain hopeful that there will be more dialogues between the two parties. And therefore, we could potentially see more of an escalation to de-escalation strategy kind of at work, and therefore allowing China to promise to buy more from the U.S. And we think energy products are probably the most likely items to see near-term momentum.
When it comes to criticism, which to be fair, we've seen from the Biden administration as well, right, over things like EVs, solar, battery overcapacity, is there likely to be any room for compromise or deal making there? Because it's such a core part of the industrial blueprint for President Xi and how he wants the country to recover.
Well, I think that for some of these discussions around the new energy sector and EVs, solar panel, lithium battery, etc., I think that those kind of discussions would probably leave a high trade barrier for Chinese products to go into the U.S. directly. But it didn't prevent Chinese products from going into other countries and from there, be exported to the U.S. And therefore, I think that we will probably continue to see that unless the new administration is specifically asking for, companies to be set up in the U.S., right? So at the same time, Are we going to see some other, room for discussion? We still definitely think so. There are not too many manufactured goods the U.S. is exporting today, other than agricultural products, energy products, and probably some of the, high-tech, specifically related equipment and machinery products. So for those products, we still think that China very much need them, and there is the room to negotiate so that China can promise to buy more, especially when it comes down to oil and gas. And in fact, we think that compared to 7-8 years ago, China has a more diversified base to source their energy products from the rest of the world. And some trade diversion towards the U.S. may not necessarily hurt, especially if it can help keep the trade barriers at bay.
Helen, can you share some more details from on the ground? Because I noticed that you were hosting your China macro tour in Beijing at the exact time of the U.S. election. So you met with investors from within China, outside, 15 meetings with academics, policy advisors, industry experts. What was their reaction to Donald Trump being elected versus Kamala Harris?
Well, very good question, Annabelle. I would say that a lot of the people probably were, investors were saying that at the very beginning, that this is not necessarily too surprising. In fact, I think the views in Beijing and also largely in Asia, I would say, where I recently have traveled quite a lot to, seems to be, suggesting that people were seeing the race being pretty tight. So people were not surprised by either party, winning. This contrasts very sharply against the very dominant view in the U.S. When I was in D.C. and also in New York 2-3 weeks earlier, there was a dominant view that the Republican candidate is going to take the White House. So that's, first of all, not necessarily a surprise. But secondly, I think there is also some kind of optimism among the clients that we have talked to in Beijing. Especially after they saw that Trump has really won the race, and probably we may actually see more trade tension escalating because people argue that this would be the opportunity for policymakers in China to step up easing measures, especially to boost domestic demand. So that was the type of optimism people has been holding. Whether they have seen enough signs of that so far, I'm afraid not. I think the easing measures so far, starting from September 24th, are more focused on, one, local government debt issues, and two, stabilization of the property market. Is that sufficient to offset any pain from potential tariff imposition? Probably not yet. But people therefore think that there is something to look forward to. Maybe there will be a Central Economic Working Conference at the in mid or late December. At the time, people probably would be able to see some kind of announcement that going into 2025, what kind of policy orientation would be adjusted to better, buffer the shock from the trade front. And maybe there will be potential policy announcement by then.
Helen Qiao there, Chief Greater China Economist at Bank of America Global Research, here to recap not only what President-elect Trump means, but also, of course, that big data dump we had at the top of the hour. And taking you to some live pictures now of officials at China's National Bureau of Statistics. They're holding a briefing talking about these figures from the October activity data. And sort of the broad headline here is that they're saying, yes, there is that economic recovery foundation, but still consolidation is needed in order to achieve that 2024 annual growth target of around 5%. Importantly, domestic demand, that's still being seen as insufficient. We did see retail sales doing better than economists have been predicting in the latest figures, so a rise of 5.8% from the prior reading, rather 4.8% versus the estimate for 3.8%. But industrial production, that slipped a little bit, some of the key figures we've been watching this morning. But you can turn to your Bloomberg for more on this and go to TLive Go to get commentary and analysis from Bloomberg's expert editors. We'll have more ahead. This is Bloomberg. You're watching the China show. We've just had the activity figures coming out for October at the top of this hour. The broad read-through on this is that we saw the economy perhaps stabilising. Consumption, that's where we really tracked that, rising more than expected. So retail sales coming in at 4.8% expansion. That's up from 3.2% the month prior, and the expectation had been for 3.8%. Industrial production, this just slipped a little bit to 5.3%, down from 5.4%. But as we said, signs perhaps of stabilisation coming through in the economy. The National Bureau of Statistics, though, is warning of a complicated external environment and also that caution around weak domestic demand. But let's see how that's translating to market sentiment this morning, keeping a watch on what's happening in consumer stocks in particular. And we are just actually seeing those gaining across the board here. For instance, Xtep, that's a shoe wearer or apparel maker there. Haidi, of course, Medea Group up at nearly 1%. But again, the figures, retail sales coming in better than had been expected. A period, of course, where we had the Golden Week holiday, but also the start of the Singles' Day event sooner than usual. Hang Seng, you can see here, snapping what has been a 5-day slump. Hang Seng Tech as well up 1.4%, as we also track the reaction that we're seeing in markets to key earnings from JD.com, NetEase. Both of those ADRs actually dropping overnight, but NetEase really surging today in the session. Also looking ahead to Alibaba's figures that are due out after the bell today. But we'll have more ahead. This is Bloomberg.
It is 11:29 a.m. in Tokyo, where Japanese markets are going on a break in a minute. And we have heard some jawboning from the Japanese Finance Minister Kato. They're saying authorities will respond appropriately to any excessive moves in the forex market. We have been on intervention watch as the yen has been hovering at that sort of 155, between 155 and 160 level, where previously we have seen episodes of FX intervention. He's saying that one-sided sudden moves in the FX market is undesirable. At the same time, we also had GDP numbers showing that the economy continues to come along at a slightly faster pace than expected, continues to really kind of back the broader fundamentals for the BOJ to stay on the path towards rate hikes, while also taking some of the pressure off the government as well. We know that the government there is finalising fiscal stimulus steps to be unveiled this month. And this, as we continue to really pass the data that we've had so far from China this morning, the domestic activity indicators are broadly a little bit of a disappointment when it comes to industrial production, suggesting that sort of engine of growth continues to be challenged. We are seeing a little bit of the green shoots coming through from retail sales, certainly. Some of that may be masked by seasonality, the sort of one-off effect of the holiday timing. We're also looking to see how that kind of goes into the rest of the year, Bell, as, of course, that stimulus continues to have that transmission effect.
Yeah, it definitely seems like the China figures are giving the broader benchmark a bit of a boost this morning, because we've actually seen the MSCI Asia Pacific Index trending down for the last 5 or so sessions. Today it's moved higher, and it started to also move a bit higher after we got those readings coming through. But let's get more now with Bloomberg MLive strategist Mark Cranfield. And Mark, what's your reading on the figures? Retail sales in particular seem to be standing out, and what sort of boost, how long does that last for Chinese equities?
Certainly a relief, because the consumer sector has been one of those that people are particularly worried about in China, that even some of the recent measures and the stimulus announcements that we've seen have not really been enough to really boost that. Even these tax reductions they're going to do on property transactions by reducing it to just 1% for buying new properties, people don't really think that's quite enough. It puts some money back in the pockets of homeowners. They can buy more furniture, that sort of thing. But it's really trying to address the people that go out and do their general spending, particularly the younger generation. So it's a good sign that the retail sales are starting to pick up. They probably would like to see even more robust numbers, but the fact that they increased nicely on the previous month was slightly better than the estimates as well. That's all good news. At the same time, industrial production was at least pretty much in line with the forecast as well. So it's a good start. But it's certainly a reminder, and you look at the property data that came out earlier today, it's still in negative territory. Again, there was a slight improvement home sale prices are still falling, though. And so it reminds the authorities they just cannot afford to relax. They need to keep this going and keep going for a long time as well to convince people that the Chinese economy is going to achieve the targets they want, especially into next year when it's quite possible that we will see trade conflict with the United States. We don't know exactly how it's going to play out, but people are prepared to expect that the United States will be increasing tariffs and China will respond in some way.
You know, one way we're seeing this uncertainty expressed is by the two stories that we have today on David Tepper's Appaloosa management. We've previously said buy everything China, but now cutting its exposure to Alibaba. Michael Burry, on the other hand, increasing his holdings of Alibaba, but also hedging for potential downside as well, right? Does that kind of tell you just the lack of consensus at the moment when it comes to Chinese risk assets?
Well, we're coming through a long period where people were largely ignoring Chinese markets, particularly overseas investors. So it's not surprising that you can't really form a consensus. We've had this very good rebound we saw started in September as the Chinese stimulus started to kick in. But we've retraced quite a bit of that already. There's a lot of relatively hot money has already come into the Chinese markets, and now it needs a reason to be convinced to stay there. The kind of data we've seen today does help, but it's really much more than that. It needs to go much further in terms of getting the wealth generation down to the whole economy and to boosting even the small parts of the economy, all areas, not just the government-linked companies, but more into the private sector as well. And it's no wonder that foreign investors are having trouble getting a really clear picture on this, and also the question of patience as well, whether they're willing to leave their money in there for a longer period while this plays out. As the government has been reminding people many times, it is not something they can fix in one day. The property market has been in trouble for a very long time. The debts are very huge. They can't really wave a magic wand and put it all right in the space of 24 hours. So people will need to be prepared to wait for longer. And typically in investing markets, global money moves around very fast. It has a short-term horizon, particularly hedge funds. Usually a 90-day window is about the most they will look at anything. So you've got that conflict between people who are willing to look down the road, the long term, and those who want quick results. And that's going to go on for some time yet.
Yeah, and Mark, I guess it's also that question of where's the best place really, and the case around US exceptionalism still seems to be strong, and it's even, of course, feeding into the outlook for the Fed, and we heard from Jay Powell overnight taking perhaps a little bit of a more of a hawkish stance, but take a listen.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
So once again, it sort of seems like traders are rethinking their expectations around the December rate cut. I think in swaps, we've definitely dropped back from that 80% odds. But how does that sort of play out, do you think, and what does it mean for Asia in particular?
Well, if the Federal Reserve does slow the path of lowering interest rates, it certainly will have a read across to Asia as well. We've seen one or two rate cuts as it is. But then again, the Asian central banks didn't raise interest rates as far and as quickly as the Federal Reserve did. So you would expect them to be a little bit slower. But certainly they've also got the situation where they've got weak currencies generally. The US dollar is so strong, so it's pushed a lot of Asian currencies back. And that means that the regional central banks, because of the weak currencies, can't do so much on monetary policy as they'd want to anyway. It's a bit of a standoff situation. So everybody needs a cooling down period. And it probably wouldn't be a bad thing if we get into next year, if the Federal Reserve does hold rates for a while. That may also quieten down some of the other asset moves. But of course, so much will depend on the friction we get once there's a new administration in the White House, because from some of the indications we've seen so far, it looks as though they want to get in some trade tariff situations, and don't expect other countries to lie down and just accept it. We're probably going to get some back and forth on that, and that's going to make investors very jittery. So we're in for a lot more turbulence, a lot more volatility, and whether the Federal Reserve slows down interest rates is just one part of the picture. There's a lot more going on in that, and people will have to be very aware of what governments have to say in terms of trade as much as what central banks are saying.
That was Bloomberg MLive strategist Mark Cranfield there in Bangkok, as we do see, as we said, Asian equities starting to trend just a bit higher, particularly following those economic readings we had at the top of the hour. And retail sales, certainly the standout on that front, because we saw them growing 4.8% in October. That was the strongest pace that we'd seen in 8 months, indicating a boost from the stimulus measures that were announced late September. Industrial output, though, up 5.3%, a little bit slower than the previous month. We're getting the reaction to this from the National Bureau of Statistics in Beijing, hearing some of the headlines here in terms of the economic recovery. They're saying that the foundation is there, but it does need to be consolidated. Concerns around domestic demand, they're still saying that's insufficient, but they are seeing a boost in market confidence since the stimulus measures were announced as well. So that's some of the headlines, and we're also going to track now, of course, the top corporate news that we're watching, and that's ASML, because it surged in Amsterdam after the chip equipment giant retained its bullish long-term revenue outlook. It's projecting sales of up to $63 billion by 2030, citing growing AI demand. ASML is seeking to reassure investors after its order intake significantly missed analyst estimates in the third quarter and sparked a sell-off in its shares. NVIDIA's Taiwan hardware partners Honhai and Quanta Computer are forecasting the boom in AI server demand will continue into 2025. The companies reported earnings that beat expectations thanks to a global rollout of AI data centers. But Honhai's slower fourth quarter outlook appears to be weighing on investor sentiment. The US FTC, or Federal Trade Commission, is reportedly set to investigate anti-competitive practices at Microsoft's cloud computing business. The FT says the regulator is looking into allegations Microsoft is blocking customers from moving data from its Azure cloud service to rivals' platforms. The report says tactics include exit fees and punitive licensing terms. We'll have more ahead. This is Bloomberg. A unique public stock forum is having a revival in China's financial capital. The daily outdoor gathering of retail investors disappeared during COVID, but as Stephen Engel reports, crowds are swelling rapidly again, spurred on by government stimulus.
On this otherwise quiet, leafy Shanghai street corner, many opinions, from the stock market to even the next man in the White House, can get quite vocal.
The market right now is so good. Look at how popular it is here.
He's talking about the so-called stock salon, an informal outside gathering of hundreds of mom and pop stock enthusiasts, everyone from so-called market gurus dishing advice to punters playing off the latest rumors, including the highly anticipated fiscal stimulus from the Chinese government. No wonder some call the Chinese stock markets a bit of a casino.
The stock market is a place with the most rumors. If you buy stocks based on rumors and sell based on rumors, you'll never make money. Believe in yourself and own your destiny. Don't trust others.
China's stock markets are, after all, dominated by an army of some 200 million retail investors. The street corner salon emerged more than 30 years ago when China set up its securities exchanges. But it went quiet after a market meltdown in 2015, moved online, and then went dead during the COVID lockdowns of 2022. But now, with a recovery in stocks since China unleashed stimulus in late September, the live salon has come roaring back to life, along with perhaps a lot of hopeful exuberance.
I think the bull market will last for 5 years or even longer, because we have more than 300 trillion in deposits. The government won't let you keep the money in banks. It will be a burden on the banks, and it will be a drag of economic growth as people no longer consume. Now, everyone is relatively conservative since the pandemic.
Conservative with spending, perhaps, but many here did not hold back when it came to Trump and tariffs.
Let me tell you about the tariff. I can assure you that it won't be high. He's just saying that. He's a businessman. He will change his approach for profits.
These are short-term fluctuations. He may increase tariffs, but increasing tariffs will actually hurt the U.S. more. The U.S. still relatively relies on China.
Large unofficial crowds like this one in Shanghai can make authorities a bit nervous in China, hence the fairly large police presence. I've seen a number of officers kind of surf through the crowd looking for who knows what among the mostly male stock-picking punters. I even had a car pull up, the windows rolled down, two guys dressed head to toe in black, big smiles saying, "You want to make money, money, money?" Of course, I passed them up on their offer. But still, another couple got out of a Rolls Royce and went into the crowd. I guess everybody in this city of business is looking for a good stock tip or two. Stephen Engel, Bloomberg News, on a street corner in Shanghai.
Yeah, well, we're certainly keeping a watch on the retail enthusiasm we're seeing perhaps in China. And actually, the NBS has just been talking about the National Bureau of Statistics in China, saying that they are seeing a boost in market confidence following the stimulus measures. Whether that's translating into earnings, though, is another thing, because we're taking a look at JD.com today. Their results actually failed to impress because there's still those concerns around the economic outlook for the mainland. Let's bring in our Bloomberg Intelligence senior analyst, Catherine Lim, joining us now. And Catherine, I mean, you can see there the reaction. We're down 2% today or just over. We had the reaction at ADRs overnight. It does seem like there's some concerns still around this business.
Right. Well, definitely, Annabelle. You know, we're talking about the October retail sales numbers that were just released like about half an hour ago. So it was a great set of, 11% online retail sales numbers that fueled the better than expected retail sales spending. But that's not a surprise because we saw the lengthier Singles Day promotions. That's yet to actually been reflected into JD's numbers yesterday. What is interesting really was that, the company didn't mention about GMV growth overnight. Well, they saw better order volumes, they saw better users, but they refrained from commenting about the GMV growth. And industry reports are now suggesting that Alibaba was the bigger gainer than JD.com in the Singles Day festival. So we really have to see what happens or what transpired from Alibaba's results tonight.
Yeah, it's really difficult, Catherine, to know if we're getting the full picture here on the shopping festival figures. But Alibaba, as you said, we're going to get those numbers out later today. They have seemed to be sort of focusing on that more premiumization play, the so-called VIP members of the platform. But what are we expecting in particular?
Yeah, the 88 VIP, they've actually been bringing more merchants online. And really, Annabelle, I guess what is interesting when we talk about the lengthier shopping festival really is that it's not just about pricing right now. We're actually talking about logistics, delivery services, refunds. And this is like part and parcel of buying online. Now, what's going to happen is that this actually impacts the cost that's incurred by the platforms, by the merchants. And I think that's where the concerned about, what is the impact on the earnings for both companies, Alibaba and JD.com, will be.
All right, that was our Bloomberg Intelligence senior analyst for consumer and technology in Asia, Catherine Lim, there as we recap some of the numbers that have been out, JD.com, and then, of course, look ahead to the likes of Alibaba. But we'll have plenty more ahead. This is Bloomberg.
Singapore is Asia's richest country with a per capita GDP that surpasses the UK and the US. But to continue to prosper, Singapore needs to evolve.
Our carbon footprint is expected to more than double in 2065. We need to look into harnessing renewable energy for Singapore.
We coexist extremely well with the wildlife. We had 9 otters here back in 2021. Today they have grown to 14 otters and they come out at 5 o'clock to play.
Leonard, we're in Punggol, the first sustainable town in Singapore.
Punggol Town is our living laboratory where we tested a lot of smart, sustainable and biophilic features within the whole district and town.
Singapore's urban planning has created a city where environmental sustainability and urban convenience intersect. I'm Haslinda Amin, and this is Momentum.
Time now for a look at what's making headlines in Chinese media, and the Shanghai Stock Exchange is reportedly revising a benchmark gauge to increase the weighting of tech companies. Shanghai Securities News says the 180 A-share index will boost the weight of firms engaged in so-called new productive forces. That includes IT, pharma and healthcare. The report also says that companies with ESG ratings of C or lower are going to be excluded from the index. But the big story, of course, is China's ties with Peru, where President Xi Jinping has arrived for the APEC summit. State media, including CCTV, says the two countries have deepened their comprehensive strategic partnership. Meanwhile, Chinese papers have also reposted Xi's letter that he published, or was published, in Peruvian media, where he pledged to push for multilateralism and promote what he calls an orderly, multipolar world. In the letter, Xi also expresses hope that a Chinese-built port in Peru will lead to greater connectivity and stronger ties between China and Latin America. Xi and Peru's president, Dina Boluarte, attended the $1.3 billion port's inauguration via video link. Also happening, of course, at APEC this week, it's the meeting between Xi and President Biden. It's going to mark their third in-person meeting. It's also, of course, going to be the last, but it is expected to focus on maintaining stability in the US-China relationship, and that's especially so since Washington is set for a leadership transition with Donald Trump retaking the helm next year. And really a lot of headlines crossing the last couple of hours or so around these selections that President Trump-elect is making for his administration, and that includes Robert F. Kennedy for leading the Department of Health and Human Services. But one person excluded is the JP Morgan CEO, Jamie Dimon, who says he's not bothered by President Trump, saying that there's no room for him in the cabinet. Speaking with us at the APEC CEO Summit in Peru, Dimon says he didn't want a government job anyway and sees the next administration facing a very tall order.
You had a big sea change that took place in that vote the other day, and some people were prepared and some weren't prepared. But I think the most important thing is whoever had been elected, and this is my belief, they are entering and could be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish them all the best. I think people try to help get through this. It could be a difficult thing with a lot of unknowns and uncertainties. And so policy is going to matter. And, of course, who runs the government will be determinative there.
President-elect Donald Trump sends a message to you that he respects you greatly, but you will not be part of the Trump administration as a Treasury Secretary, if that were something that were interesting to you.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years, and I'm not about ready to start.
I want to start by also talking about the response in markets in the U.S., which has very much been, this is going to be a pro-growth shock with companies that are going to be investing much more, deploying cash, aggressive in terms of U.S. expansion. Have you seen any signs that that's truly the case?
Well, yeah, you've already seen, the markets have responded quite well. And, I think America needs a growth strategy, so I literally applaud that. I think collaboration between government and business is the way to have growth. They've already spoken about a deregulatory environment. I want to point out, I'm not talking about just getting rid of regulations, but the regulatory environment in most countries has become stifling. And in a lot of countries, including Peru, it's why you're growing maybe at 2.5%, not 4 or 5. In America, it's why we've been growing at 2% for 20 years and maybe not 3. So I do think it's a reasonable thing to have that kind of reform. And that reform has to go deeper than just regulations, which can unleash capital and investment and banking and stuff like that. It's got to be permitting and all the related things that come with that, where people, you were just mentioning a mine that someone bought that could do rare earths in the United States. It's 10 years. They haven't gotten their permits yet. I mean, it's a shame, and we're doing this to ourselves, and it's a mistake. So I applaud any government that says, I'm going to make government more efficient. And I think inefficient government is one of the reasons that people are frustrated. That's why you have some populism, because they may blame, they may look at big companies, but they also know their government isn't spending their money wisely.